Hey everybody, welcome to my video on loanable funds markets. This is the first one. There will be a couple on this topic. What are we doing here? This is basically a supply and demand model. All of our regular stuff's going to apply. It's just a very specific application of that model. And so what's on our quantity axis? It's savings and investment. This is measured in dollars or whatever currency it is you're interested in. But this is measured in money. How much money is being saved, how much money is being lent. The vertical axis is real interest rate, because that is the price of loanable money. So let's see, we'll get a demand curve, which is our investment curve. It's a function of interest rates. Law of demand still applies when higher prices are associated with lower quantities, etc. And this demand curve is made up of the people who are investors. They are borrowing money for the sake of spending it today. So these ones are the ones who are, as I said, they're borrowing. On the supply side of the model, we're going to start with a very simple curve where the supply is fixed. This happens in a lot of early intermediate macroeconomic models. So we've got this savings curve, which is the supply of loanable funds. These savers are the ones who lend money to the investors. Now, because we're starting with inelastic savings, or fixed, we're going to fix it at that level of S bar. And the interest rates will adjust until we reach this equilibrium price, this equilibrium interest rate. Now, a little bit of a precursor for what's coming in a different video. We could do a model where there was a demand curve like so and a supply curve like that. All right, that's fine. But that kind of endogenous supply is not for this video, so we will save that for another day. So let's do an example of this. This is going to be kind of a short video. I'm going to do this example and I'm going to change it twice. Let's say we have an investment curve of 300 over R, a savings fixed at 60. Put this on a graph. There's our investment curve, there's our savings curve. $60 are being saved. What will be the interest rate in equilibrium? We find it by setting these two curves equal to each other. So 300 over R equals 60, which means that R is 5. And so you can show that on the graph. Great. You found yourself an equilibrium. Now, what if we change this market? What if we say savings decreases? Maybe to a lower level of savings of 50. Savings shifts left, and our graph now looks like this. We can solve again for a new interest rate because the quantity is already fixed. So 300 over R equals 50, R equals 6. All right. This sort of skill of setting these curves equal to each other to solve for a price, if you're kind of new to this, because we haven't done this in my macro class yet, we've done it a million times in micro, it might be worth looking at some of my supply and demand videos in my microeconomics playlist. But it's not going to be much different than this. So maybe it's not worth your time. I don't know. Let's do a third example. What if from the green equilibrium, what if our investment increases to 400 over R? Well, on the graph, that looks like this. We have this new investment curve, and we got to solve for a new equilibrium. 400 over R equals 50, which means R equals 8. And there's your new equilibrium where S2 intersects investment 2. Okay, so we can do lots of this stuff. It's pretty straightforward. So let me just say a couple of the big lessons. There's a supply curve. It's made up of people's savings. These are the people who want to lend money. And there's a demand curve. It's borrowing. These are the people who want to invest and build some capital. All the laws of supply and demand fit. So if supply falls, you're going to see your price, your equilibrium price, also known as your interest rate, it's going to rise. If your demand rises, you're going to see your equilibrium price, which is your interest rate, it will also rise. And there's a lot more combinations of that. You can move supply and demand both ways. You can move one of them. You can move both of them. Don't overthink it. This model is pretty straightforward. So I hope this was useful to you. If not, too bad. Good luck, you guys, and thanks for watching.